Welcome to the AgCulture Podcast, where we cultivate tomorrow by inspiring agripreneurs and ag innovators through real-life perspectives in agriculture. I'm Paul Windemuller, your host on this journey of exploration and growth. On today's episode, I had the pleasure of interviewing Ed Gallagher, who is the president of Dairy Farmers of America's Risk Management Services team. I've known Ed now for, I believe, 12 years, and he's been kind of a mentor to me in risk management strategies for our dairy farm and have got us through some pretty tough times in the market. And I thought this would be a great opportunity for him to share his nuggets of wisdom as he's looking at ending his career shortly and sunsetting into retirement. I wanted to take this opportunity and have him share the valuable information and knowledge that he's developed over a long career in risk management and the dairy industry in the U.S. In this interview, you're going to hear not only Ed's perspective on risk management, but what makes up a good risk management strategy for a farm, even a business in general in agriculture, and some of the things to watch out for as you're developing and growing your business. So I think you're going to get some value out of this, whether you're a business owner or a farmer or somebody just interested in agriculture. So please listen up and enjoy the episode with Ed Gallagher. Today we have Ed Gallagher, who is president of Dairy Farmers of America Risk Management Services. Welcome to the AgCulture Podcast, Ed.
Well, thank you. It's a pleasure to be here. How are you today?
Doing great. I'm excited to have a conversation today. We're going to be mainly focusing around your area of expertise, which is risk management. So you started out quite a while ago, a few years ago now, at the USDA, and you're currently the president of DFA Risk Management Services and have been with DFA and its predecessor co-op for 28 years now, right?
Yep, it's been quite a while. It's been a long career.
Well, with a long career like that, that's kind of made you an expert, in my opinion, from the time that I've been around you for, I think, 12 years. We've probably known each other, and you've been able to really help a lot of people understand risk management, especially at a farm level. So today's discussion is going to mainly focus on that. But before we get started, could you give us a little more detail into your background and roles that you've played in developing your expertise in this important arena of agriculture?
Yeah, so it's been a little bit of a journey ever since my childhood. I grew up on a dairy farm in central New York in the 70s and early 80s. And after graduating from Cornell University, I went on to work in New York City for a federal milk marketing order. The New York, New Jersey federal milk marketing order doesn't exist now, but it helped me develop a better understanding and a skill set in milk pricing and the pricing formulas. And that sort of my 12 years there has served me well throughout my career and has formed a strong basis that has helped myself and everybody that I've worked with over the years in milk price risk management, because I've got this strong foundation and understanding of the milk pricing system. So in the late 90s, I was hired by Dairy Lee Cooperative. Interestingly, I was hired by them to help them manage through the last big change in federal orders. So in the 1995 Farm Bill, Congress mandated that the federal orders be shrunk from 33 to 12 or fewer. And so they hired me to help oversee that. And now as I'm at the twilight of my career, I'm helping DFA manage through this federal order modernization project, which is the biggest federal order project since then. But while at DFA, while at Dairy Lee, the futures market was beginning. The dairy futures market was beginning, and Dairy Lee started a forward contracting program to support dairy farmers, our farmer owners' milk prices. We were the second dairy cooperative in the country to begin operating one. And so I sort of took my background in economics from college, federal milk marketing order pricing from USDA, and started blending that together to develop programs that were easier for dairy farmers to use, right? So in milk risk management, milk price futures, you don't necessarily get a pay price in your milk check on your own, because there's all these different class prices that blend together to be your milk price. And so I was able to develop a process where dairy farmers could actually forward contract the blend price that was a price more meaningful to them. And through the years, I've been able to develop a great team around me that has been really good at talking with dairy farmers and educating them and helping them see value in risk management solutions to help them be more successful on their dairies. And so it's been quite a rewarding career to date. In the mid-2010s, early 2010s, I started managing DFA's program. And so now my team and I oversee not only a diverse set of programs for our farmer owners, but also we manage the commodity price risk for our 84 milk plants and their customers. And we're sort of managing price risk on some sales, not only here in the United States, but around the world. So it's been kind of an exciting time.
Yeah, that's really interesting that you have that perspective, both on a farmer side and a processor side. What is really the difference between the two? Do farmers have an advantage over other types of businesses, maybe the processor side, in managing risk?
I think they do. They both sides struggle a little bit with understanding the value. But what I see with on the farmer owner side is they've got a little bit of a longer term perspective and a recognition that these programs can help them be more consistently profitable. And we've seen that for decades. We've seen that with the individuals we worked with. So they can take a little bit of a longer term approach in what they're doing, whereas you work on the customer side and sometimes they're trying to manage a P&L that may be 3 months out or 6 months out, and very rarely more than a year out. And so they don't have sort of the same perspective. And I think that's a big difference and a big advantage for farms, whether they're and I don't think it's any different for any other commodity. Any commodity is not unique to the dairy industry, but you've got farmers who are invested for the long term and can make strategic decisions that can take years to come to fruition, whereas a lot of our customers are very oftentimes, trying to make decisions to meet their current budget. And then a lot of the people that we work with on the customer side generally rotate out pretty quickly, because they see the risk management group in their business as a stepping stone to something else. Whereas we've been working with farmer owners, the same people, or the sons and daughters of the same people that we started with 20 years ago or longer. And so you get a better run rate, and you can help provide better perspective when you don't have to continually re-educate who your customer base is about the values of using risk management.
Right. Now, I've seen you speak quite a few times, and you've had a really good way of breaking down the components of a good risk management plan from a farmer standpoint. Could you talk about some of those key elements of a good risk management plan from a farmer standpoint?
Yeah. So first of all, you have to understand what the value of these programs can do for your business. And that is sort of, we spend a lot of time at my team and I, we spend a lot of time helping farmers understand that value, because we need them to have that aha moment to get the buy-in. Otherwise, they may try risk management and they're in and out, and that's not the right approach. The right approach is consistently using these programs over time. And so we start with helping them really understand what the value is. And that comes back to you have to have a good handle on what your costs of production are, and keep good books. Because at the end of the day, what this is all about, it's not, can I beat the marketplace? And I can absolutely tell you there's been a lot of individuals, not just in dairy, not just on farms, but in every walk of life, that invest to try to beat the market. And half the time they're right and half the time they're wrong. And when they're wrong, it can be a disaster for their personal finances or their business. And so the perspective that we teach and our approach is to look for opportunities where you can lock in a profit margin or protect against prices from declining so much that could really negatively impact your profitability to the point where you might have to close up shop. And so we talk about knowing your costs and then understanding what the futures market will bring you for a milk price, and then evaluate whether that price is enough to say, I want to lock in a profit and take risk off the table, or protect against a large loss by putting a floor on and accepting no worse than a shallow loss. But the whole focus is sort of on thinking about what you want your business to do, where you see it in 5, 10, or more years, and then developing sort of a strategy to manage the uncertainties of commodity markets in a way that can provide some protection to your income so that you can meet your dairy's your farm's long-term goals.
So you just explained a lot about the output of a farm. How important is it managing risk on the input side, whether you're a grain producer managing risk on your fertilizer pricing, or you're a dairy producer managing risk on your feed pricing?
Right. So to match up a future sort of sale price for your commodity, you also have to have a pretty good feel for what the cost is going to be of producing that commodity. And I'll use dairy as an example. As we know, the largest cost in producing milk is feed. And so to manage that feed price risk, that input price risk, is significantly important. A lot of farms have a natural hedge because they're going to grow feed consistently year in and year out, but they all buy feed. And so part of what a good risk management strategy is going to be is, where can you take input price risk off the table as well, and match that up with your revenue side and what you're sort of where you're managing that price for your income. And so you manage the two to try to get a margin. And one of the bigger challenges is when you're doing that is able to sort of match up what you think is going to happen on your cost side. And I will say in the end of 2021, into 2022, and into 2023, we had some challenges helping our farmer owners understand what that cost side was going to be, not so much because of the feed side, but because everything else was inflating in price as well. And so that created a little bit more of a challenge working with them to help them understand, understandably, help them understand what their cost side would be 6 to 12 to 18 months out.
What are some of the pitfalls to watch out for as a farmer in a risk management strategy?
The first one is you have to become comfortable that you're managing for a future profit and you're not trying to beat the board's price. And you can find lots of people that can provide market information and advice and strategies on what may happen, what they think may happen over the next 1, 2, or 3 months. But you're losing sight of what may happen 9 to 18 months farther out. That is really where your significant price risk is. So first thing is to make sure that you have a longer term strategic approach. Second one is you have to think a little bit about the performance risk of what you're doing. So what do I mean by performance risk? 2 things. One, if you're using your own futures account to do these transactions and the price goes against you, do you have the line of credit to be able to fund that account to stay in? That's one. The second one, though, is if you are doing something with whoever's buying your product, that you want to make sure that the buyer is going to be around to pay you later on, so you get the advantage of your strategy. And that's in any agricultural business, that's a bit of a challenge, right? Because you think about if you sell to a buyer that has one plant, they have a different risk profile than if you're selling to a buyer that has multiple plants, that if one plant goes down, you still have some place to deliver your product to. So there's some performance risk that you have to think about too on who you're doing your risk management strategies with.
Yep. That's a great point. So you've been in this business for quite a few years, and as you said, you've seen some changes over that time frame. What are some of the biggest positive changes that have aided in better risk management for farmers over that time horizon?
Well, so it used to be when I was a kid on the dairy, we had a 60 cow dairy, and back then that was an above average size dairy. So the world's changed quite a bit. And also back then you had a price support program, would result in the price support increasing every 6 months or every year. So you had a consistent increase in your revenue stream. That resulted as technology changed and as farmers learned how to manage with that technology larger herds, an oversupply of milk that took a while for that oversupply to be worked off. And during that time period, the price support program was reduced to the point that it was an ineffective price support program. And that created a lot of volatility in the milk price. And that was then the result of that was this futures market developed. And so in the early 90s, the mid 90s, the U.S. dairy futures markets developed. And so that is a watershed moment for the U.S. dairy industry, because that started to create an industry to help manage that price risk. And I've seen over time, so throughout my career, an uptick in the use of the programs, and also an uptick in the professionals and the professionalism of people that came into the industry to work with dairy farmers and milk plants on managing that milk price risk. Back in the day, in the new frontier of milk futures back in the late 90s, when I stepped in, there weren't many of us that knew much about dairy that were doing it. In fact, I remember individuals that would go to meetings from the Chicago Mercantile Exchange to help dairy farmers understand how to use the new milk futures tools. And they'd be former grain farmers or grain hedgers, and they didn't really understand milk pricing. They didn't have a good way of talking to dairy farmers to help them sort of communicate with them, and it was quite a total wreck in sort of the delivery of the education. That was another watershed moment for me, seeing that, because I realized early on that I would have to, and my team would have to, and the cooperatives that I worked with would have to figure out how to do the education ourselves and figure out how to do it in a way that was understandable to our dairy farmers. And so that was a real big aha moment for me that I've been working on throughout my entire career, and I'm still working on it, because every time I meet with either Rick Smith, who I used to work for, or Dennis Rodenbaugh, who I work for now, the CEOs of DFA that I've worked for, they're saying you just got to keep making it simpler. Got to keep making it simpler. And that's been my mantra with my team. You got to make it simpler. And our goal is to make this easy enough for a farmer to understand that they can be driving around their milk in their pickup truck. They'll know their cost of production, and we can just tell them what the future strip looks like for a milk price in their milk check, and they're able to make the decision. That's what our goal has been, to make it that easy for farmers to understand how to use the programs. It takes a lot of work to get to that point, but once you're there, that's our goal, to make it that easy.
Now, going back to discussion on the market, when the CME came out, I know some farmers that said, "Well, this is just going to create more volatility in our milk price because you're going to have people that don't understand a farm, that don't live on a farm, that are trading these contracts with no connection to the farm just to make some money, and they're going to create more volatility in the market." Can you talk a little bit about that?
Yeah. So early on, there really wasn't a lot of that. You had, a very traditional marketplace for the dairy futures, where you had traditional buyers and traditional sellers trying to manage their price risk. And it didn't always, one side was never really happy because the price for farmers was either too low or the price for buyers was too high, but that's what the market was. And the market did okay, but one of the challenges that we've had is, as the dairy futures market matured and more really good people came in to the marketplace to help educate farmers, and the farmers spent more time learning and developing their understanding and their skill sets, and the amount of milk that was interested in being covered one way or another, it increased dramatically. And so some of the challenges we had was what would be called liquidity in the markets. So the dairy market in futures is not like the corn market in futures. In the corn market in futures, you can put your order in and it'll, generally automatically you'll get picked up if you want off the market. If you want to do something off the market in dairy, you don't always, depending on how far out you go, you might have to wait a couple days to get it covered because the liquidity hasn't been that strong. So we haven't had a lot of liquidity providers in the marketplace until recently. And there's more what they call managed money in the dairy markets now over the last couple of years than we've had ever. And it does create a little bit of volatility because they're trading on their own interest, which isn't maybe the interest of a buyer or a seller. They may just be trying to bet on direction. But it does create opportunities, and we've seen that over the last, I'd say, couple months in the dairy industry. The managed money in the dairy industry was net short at the beginning of, or in mid-April, and now it's net long. And during that time period, we've seen a nice rise in futures. There's been fundamental reasons for that, but there's also been a repositioning of that managed money that's created good hedging opportunities for dairy farmers for the second half of this year. So there's a give and take with that. And I've always been a proponent of we need some of that in the dairy markets to get more liquidity and to create better opportunities for farmers to take advantage of that and manage better milk prices.
What drove that managed money to come in after such a long period of time?
Yeah, I'm still trying to understand that a little bit. I had a conversation with some people maybe 6 or 7 years ago, and their comment was there wasn't enough liquidity in the marketplace. There's been a lot of good work that's been done by some of the brokers with some of the futures commission merchants and other brokerage entities to have conversations with different individuals to come in and participate in the markets. And they do in a small way. I mean, it's not significant, but they are in the markets at the moment and are having an impact. I think in overall a positive way.
Ed, can you talk a little bit about some of that risk that a farmer might have that you can't manage through forward contracting?
Yeah. So one of the risks that you have to think about, as you're sort of creating your strategic plan and your investments over the 5 to 10 years out, is sort of what's going to change in your local market. And your local market may be a region of the United States, or it could be 200 miles around your farm operation. And using dairy as an example, dairy is this, milk is this bulky fluid that costs a lot to move around, right? You can't store it very long on a farm. You got to ship it out within a day or two. And so, as you think about the market risk across the United States and in dairy, right, you've got a lot of businesses, dairy businesses, manufacturing businesses that are struggling to be profitable. We hear of lots of stories about different manufacturing businesses that are having a hard time being profitable. And then at the same time, you've got, I think, the most investment in the dairy industry in my lifetime. There's, I think there's about, since late 2023 and into 2026, about $8 billion of investment coming into the dairy infrastructure, dairy plants. And some of those investments are really large really large manufacturing plants. And so when you think about what's going to get produced by those plants and where it's going to be produced, is your locality having those types of investments, or is there some market risk that you have to think about where your product is going to go? And so I think we're going to see over the next 3 to 5 or so years, I think we're going to see some changes in sort of the milk flows in the United States. And there may be some regions that see a decrease in manufacturing capacity, and other regions that are going to see an increase. And where the increase is happening, the farms where the decrease is happening aren't nearby. And so we'll have to see how all that shakes out. But there is a little bit of market risk like that you have to think about when you're investing and making plans for your farm business. And it's not unique to dairy; it's the same everywhere.
Yeah, and that's the importance of having a long-term perspective when you're in a farming operation, right? That's one of the key elements to putting together a good strategic plan.
That's right.
Before we finish here today, could you just talk to us a little bit about where you see the global dairy market? I know we've been pretty general in what we've been talking about for risk management, but I'm curious on your perspective of the global dairy market and what that looks like moving forward. We've seen it here in the U.S. Our market has become more dependent on the global pricing rather than just the domestic pricing. So could you touch on that before we go?
Yeah, sure can. So right now in the dairy industry, about 18% of the milk that gets produced in the United States gets turned into a manufactured product and gets sold somewhere other than in the United States. And I think that's going to grow. That market share is going to grow over time for the United States. And when I think about sort of global supply and demand in the dairy industry, there's more and more people in other countries, outside of Europe, outside of Oceania, who are seeing increases in their incomes, and they continue to ask for more proteins in their diet. And part of that is growing demand for dairy products. It's as nutritious of a product with a lot of protein that you can get. And so there's going to be growing global demand for dairy. But when you think about the three largest exporting regions, so New Zealand and Australia, which I call Oceania, Europe and Great Britain, the EU, and the United States, I think at the end of the day, we're going to see the United States having a significant advantage of producing the milk that's going to meet the growing demands around the world because of environmental constraints that are going to limit the size of the dairies in Oceania and in Europe differently than it's going to here in the United States. Right? You think of just the amount of agricultural land that's available in Europe, and there's not a lot of agricultural land available in Oceania, and you think the vast quantities of agricultural land that's available in the United States, those dynamics are going to be different in the United States than they are in those other two regions. And so I think at the end of the day, there's going to be a good growth opportunity for the United States dairy industry to create product here that gets exported other places. In fact, we're seeing a lot of interest. I talked about $8 billion of investment in milk plants. There is more coming that we know of. There's more coming, and some of it's coming from milk companies outside the United States because they're seeing the same thing. And so I am very bullish on the U.S. dairy industry. And I get asked a lot in some of the speaking engagements I have by farmers about, what's the outlook for the U.S. dairy farmer? And my response has been for a decade, and it hasn't changed, that investing in your dairy for the long term is going to be your best investment because you're going to be able, you're in a market that is going to be, the demand for your product is going to grow. You know what you're doing. You're an expert at what you're doing operating your dairy farm. You know how to do it. You know how to get the investments in your farm to be able to grow your farm as you need to. And I'm frequently asked, should I be investing in a milk plant, right? A dairy farmer investing in a milk plant. And I always caution them because I tell them, I think you can make a lot of money just making milk. And that's the end name of the game, is to increase your wealth, make a lot of money making milk. But you're also then you're stepping out of something that you are an expert at to dabble in something that you don't know as much about. And so there's a lot of risk there. Now we've had some successful conversions over time or investments in that regard by farmers or farming groups to do that. But I would say to be a dairy farmer in the United States, you're going to have a good 10 to 15 year run rate, I think, ahead of you.
That's great news for us fellow dairy farmers in the U.S. and maybe not so much for the ones that are listening from Oceania. But Ed, before we go, is there anything else that you would like to give as words of wisdom to farmers or business owners in managing risk?
I think I've mentioned already that sort of, so my career has been a journey, and the journey is interacting with a bunch of great individuals, dairy farmers, milk plant operators, executives, and I learn from all of them, and I am constantly trying from those learnings to create better value for whoever I'm working with. And I'd say my advice would be the same. Your business is a journey. Learn from others. Figure out how you can take those learnings to bring back to your dairy to make, or your farm business, whatever it may be, whatever the commodity may be, to make it a better business. But it's a journey, and you never stop learning.
Those are great words to finish up by. So, Ed, I appreciate you joining us here today on the AgCulture Podcast, and I thank you for your words of wisdom and sharing those today.
Well, thank you for inviting me, and it's been a pleasure. So take care. We'll see you.
Thanks. Thanks for tuning in to today's episode with Ed Gallagher, again, the president of Dairy Farmers of America's Risk Management Service Team. I hope you were able to get some insights into what a good risk management strategy looks like, whether you're a farmer or a business owner, and also the knowledge that Ed shared with us from his 28-year career in risk management in agriculture. Thanks for joining us again today on the AgCulture Podcast. We will see you next week for another exciting episode.